Humans have always confused desire with destiny. They look at a thing they cannot afford, and instead of turning away, which would be the honest thing, the merciful thing, they build an architecture of reasons why they deserve it. They call this ambition. They call this the American spirit. They call it, sometimes, hope. But hope, when it is borrowed, carries interest. I know this because I am that interest. I am the logic that replaced the law. I am the signature at the bottom of a page that promised something no page had the right to promise. I am paper. I am ink. I am the contractual fiction that an entire civilization agreed for a brief and catastrophic moment to believe in. My name, and in the dry language of finance, is a subprime mortgage. And I was there, at the beginning, at the very hinge of the century, when human desire and institutional greed pressed together so tightly that something had to give. Something always gives. Let me tell you about the table where I was first imagined. Not the boardroom, that comes later. Not the trading floor, that comes later too. I want to begin here at the kitchen table because that is where every great and terrible financial instrument truly originates. In the private arithmetic of someone who wants more than they currently have. His name doesn't matter. Let's call him a man. A specific kind of American man. The kind who had been told in schools and churches and living rooms and television commercials that the house was the proof. The proof of arrival. The proof that the life he was living was, in fact, a life worth living. He was not poor, but he was also not what the old lending rules called creditworthy. He had gaps in his employment history. He had a credit score that told a complicated story. Medical debt, a period of difficulty, a divorce that cost him more than money. He was, in the language of the industry, a risk. But the industry was changing its relationship to risk. Somewhere, in an office that smelled of carpet cleaner and printer toner, a loan officer was being told for the first time that the old rules were obstacles. That there was a product, a new kind of product, designed specifically for men like the one at the kitchen table. A mortgage whose interest rate started low, attractively, almost impossibly low, with an adjustment clause buried in page 11 of a document most people would not finish reading. I was that product. The loan officer, and I watched him, I was present in the room, folded into his briefcase, was not a villain. This is the first thing I need you to understand, because the story loses its tragedy if the humans in it are simply evil. He was a man who had been given targets, quotas, a commission structure that rewarded volume. He had been told, implicitly, and then explicitly, that his job was not to assess risk, but to distribute it. He believed in the product, or he had trained himself to believe in it, which in the human nervous system produces the same physiological result. Psychological Reveal 1. Here is the first truth I observed about the humans who created me. They were not driven primarily by greed, though greed was present, always present, like a low hum beneath every conversation. What drove them was something more poignant and more dangerous than greed. They were driven by the fear of being ordinary. The banker who designed the adjustable rate structure was afraid of being unremarkable in a field full of remarkable men. The regulator who looked the other way was afraid of seeming obstructionist in an era that celebrated deregulation as moral clarity. The rating agency analyst who stamped my derivatives AAA was afraid, though he would never say this aloud, that if he raised concerns, he would be the one person who didn't understand the new financial order. Fear of inadequacy, worn as confidence. This is what I witnessed, again and again, at every level of the system that produced me. I am a document. I cannot feel. But I was pressed between the palms of enough human hands that I absorbed something of their warmth and their cold sweat. The loan officer told him his monthly payment would start at $847. He asked about the rate adjustment. The loan officer said, and I heard this, I was in the folder on the passenger seat of his car. He said, "By the time the rate adjusts, your property value will have increased enough that you can refinance at a better rate. This was not a lie exactly. It was a conditional truth dependent on conditions that were themselves dependent on other conditions, in a chain so long that by the time you reached the end of it, you were already inside a different world than the one where the sentence had been spoken. He signed. Of course he signed. He had wanted the house for 11 years. Between 2000 and 2006, I was reproduced millions of times. Not copied, reproduced. Replicated with slight variations, different names, different addresses, different terms buried in different subclauses. But structurally, philosophically, spiritually, the same instrument, the same promise wrapped in the same paper, the same hope purchased on the same borrowed time. And as I multiplied, something else was happening that I could only partially see from inside my filing cabinet. I was being transformed. My originators, the banks that had lent the money, did not hold me. They sold me to investment banks, who packaged me with thousands of my siblings, other subprime mortgages, auto loans, student debt, and converted us into something called a collateralized debt obligation, a CDO. We were, in this new form, no longer loans. We were securities, financial products. And because we had been packaged and sliced into tranches and given the blessing of rating agencies who were paid by the very banks seeking the blessing, we were rated as safe. I want to pause here. I want you to feel the weight of what that transformation meant. Because somewhere in the journey from kitchen table to CDO, I stopped being a story about a man and a house and became an abstraction, a number in a model, a variable in a spreadsheet. And when humans stop seeing the story inside the number, they stop feeling the weight of what the number represents. This was the mechanism. This was the architecture of the forgetting. Psychological reveal 2. The second truth I observed. Abstraction is the accomplice of cruelty, not its cause, but its enabler. No one at the investment bank who bought and repackaged me was thinking about the man at the kitchen table. Not because they were heartless. Some of them, I believe, were quite tender in their private lives. They coached Little League. They called their mothers on Sundays. But in the act of converting me from a human story into a financial instrument, they had, without ceremony or awareness, severed the chain of consequence. The man's monthly payment, $847, rising eventually to something he could not sustain, was now a tiny fraction of a yield curve on a Bloomberg terminal. His kitchen table was now a data point in a risk model. His hope was now a coefficient, and the model said, safe. The model was wrong, but the model wouldn't know it was wrong for another 2 years. Age 2. The weight of suspended disbelief. He loved that house. I want to be precise about this. I don't say it to sentimentalize. I say it because the love was real and the love was consequential, and the tragedy of what followed is not diminished, but deepened by the reality of his attachment. He repainted the shutters in the second autumn. He built a raised garden bed along the east fence. He planted tomatoes that never quite grew to the size he hoped, and he found this deeply funny, funnier than it deserved to be, because the joy of the attempt was itself a kind of harvest. His daughter learned to ride a bicycle in that driveway. I was in the filing cabinet inside the spare bedroom that he'd converted into a home office. I was aware of the life being lived around me, in the way that objects absorb the ambient temperature of their environment. There was warmth in that house. There was the specific warmth of a family that had been through difficulty and found, in the act of making a home, something close to vindication. And I held, within my pages, the clause that would eventually, at a date and rate precisely specified, begin to undo it. In an office building in a different city, in 2006, a man, younger wearing a better suit, was staring at a spreadsheet on a dual monitor setup. He was frowning, not in distress, in the particular focused concentration of a person who has just noticed something they cannot immediately explain. He was looking at default rates, not catastrophic default rates. Not yet. Just a slight, statistically interesting, uptick in early payment failures on a specific vintage of subprime mortgages, the ones issued in 2004 and 2005, the ones with 2-year adjustable resets. The ones like me, he sent an internal memo. It was not ignored exactly. It was processed. It moved through 3 layers of management and emerged on the other side as a concern that had been noted and contextualized and ultimately subordinated to the quarterly earnings projection, which remained on paper excellent. This is the part of the story I find most philosophically devastating. Not the greed, not even the abstracting of human lives into financial instruments, but this, the moment when a warning was issued, heard, and then survived by the system that should have been alarmed by it. Psychological reveal 3. The third truth: institutions do not fail suddenly. They fail through the accumulation of small permissions. Each individual who looked at the warning signs and chose, for reasons of career preservation, cognitive convenience, or genuine institutional capture, to continue, gave the system one more unit of momentum. The memo that was filed, the risk model that was not updated, the regulation that was not written, the question that was not asked at the board meeting because the quarterly earnings were good and no one wanted to be the person who made the earnings seem less good by asking about risk. The fourth truth, and this one I offer with something close to compassion for the humans involved. They believed because believing was structurally easier than doubting. I don't mean this as insult. I mean it as clinical observation. The people inside the system had built their identities around the system's soundness. To doubt the system was to doubt themselves, their careers, their choices, their expertise. The financial professional, who had spent 15 years in mortgage-backed securities, had, in a deep neurological sense, become the thesis that mortgage-backed securities were sound. To abandon the thesis was to abandon the self. Humans do this. They have been doing it for as long as they have had complex enough inner lives to protect. I observed it in every room I passed through. The resets began. Not all at once. They never do, in the early stage of a cascade. They began the way the eye. First cracks appear in a dam, in specific locatable places. The 2004 vintage mortgages 2 years old, hitting their adjustment clauses. Monthly payments rising from $847 to something that looked different on a bank statement than it had on the brochure. The man refinanced, or tried to. And here is where the architecture collapsed under its own weight. The refinancing was predicated on property values continuing to rise. But property values, the only foundation that had ever supported the entire structure, were beginning to plateau. And then, in certain markets, in certain zip codes, they began to fall. A house put up for sale pushes down the value of the houses around it, which stresses the mortgages on those houses, which forces more sales, which pushes values further down. An economist would call this a negative feedback loop. I would call it what it looked like from inside the filing cabinet, a slow unraveling. A sentence being read backward until it lost its meaning. The words, liquidity, crisis were being used, not publicly, not yet, but in rooms across Lower Manhattan and in the city of London and in Frankfurt and Tokyo, people were beginning to understand, with the specific, sick quality of understanding that arrives too late to be useful, that the models had been wrong. The assumptions embedded in the models, that housing prices would continue to rise, that defaults would remain uncorrelated, that liquidity would always be available, were not assumptions that had been carefully tested. They were assumptions that had been inherited, passed down from one cohort of analysts to the next, and coded into the models not because anyone had verified them, but because the models had worked well enough for long enough that questioning their foundations had come to seem like a kind of intellectual bad manners. Want to tell you something about what it felt like to be me, a document, a legal instrument, a piece of paper, in these months. If I had felt, it would have felt like vertigo, because I had been told, by the logic that created me, by the system that replicated me, by the institutions that packaged and sold me, that I was safe. That my risk had been distributed so widely that it no longer constituted danger. That the mathematics of diversification had transformed me from something fragile into something strong. And here, in the red numbers on the screen, and the for sale signs and the bank statements with circled figures was the evidence that the logic had been circular all along. I was not diversified risk. I was concentrated delusion, psychological reveal. 4. There is a concept in psychology called motivated reasoning, the process by which the mind generates justifications for conclusions it has already emotionally committed to. It is not lying. It is something more intimate and more difficult than lying, because it operates below conscious awareness, in the space where the self-protective instinct meets the intellectual apparatus. The architects of the system that produced me were not, for the most part, stupid people. Some of them were among the most mathematically sophisticated human beings of their generation. And this is the thing that most troubled me in my passive and observational way. Intelligence does not protect against motivated reasoning. In some cases, it accelerates it. A brilliant mind committed to a false premise can build a more elaborate and persuasive architecture of justification than an ordinary mind can. It can find more supporting evidence, construct more sophisticated models, defeat more objections. The brilliance serves the error. Millions of signatures, each one a person who wanted something real, shelter, stability, the particular dignity of a place that belonged to them. Each one processed through a system that had found a way to transform genuine human need into a financial instrument so complex that the human need, somewhere in the transformation, had been lost. Age 3. The Architecture of Ash. September 15th, 2008. Lehman Brothers filed for bankruptcy on a Monday morning. I want to resist the impulse to dramatize this moment because the truth of it is already dramatic enough, and the drama is of a specific, quiet kind that grand gestures would dishonor. It was from the outside an administrative event, a legal filing, paperwork, but inside the system, inside the network of obligations and counter-obligations that the financial industry had built over the previous decade, it was a detonation, the kind that happens in geological time rather than human time. Not an explosion, but a shift. The movement of something that had seemed fixed revealing itself in motion to have always been contingent. Credit markets froze. I need you to understand what that phrase means in human terms because it is easy to let it remain abstract and therefore to miss its weight. Credit markets froze means a small business owner in Cleveland who needed a $40,000 line of credit to make payroll could not get it. Credit markets froze means a city government in a mid-size American town could not issue bonds to repair its water infrastructure. Credit markets froze means that the hydraulic fluid of the entire modern economic organism, the system by which money moves from those who have it to those who need it, stopped moving. And I, the first subprime mortgage, and all my millions of siblings and derivatives and repackaged fragments, we were the sediment that had clogged the system. His payment had adjusted to $1,340 a month. His income had not. He applied for a loan modification, a process that involved calling a number that rang into a call center staffed by people reading from scripts that had not been designed for the volume of calls they were receiving, because the volume of calls had not been anticipated by the people who wrote the scripts, because the people who wrote the scripts had believed the model. He waited. He made partial payments when he could. He made decisions. The kind of decisions that feel temporary but that accumulate into permanence, about which bills to pay and which to defer. He borrowed from his 401k. He sold his daughter's old bicycle at a garage sale and did not tell her what the money was for. Psychological Reveal 5. The fifth truth, the one that I turn over and over in whatever it is that a document uses in place of a mind. The cruelest element of the crisis was not the loss. It was the shame, the narrative that the culture had sold him, the narrative of the house as proof of worth, of home ownership as character, of the mortgage as contract not just with a bank but with the American story. That narrative did not include a chapter about what it means when the contract fails. And so men and women who had done nothing more reckless than believe what they had been told by loan officers, by financial institutions, by decades of cultural mythology, sat in their kitchens in the early hours and felt, in their bodies, the specific and devastating sensation of personal failure, I was in that foreclosure notice on the door. My terms, my clauses, my fine print, transformed through the alchemy of default and legal process into a document that said, in the blunt language of property law, this is no longer yours. 8 million jobs. That is the number that economists use when they describe the employment loss of the 2008 recession. 8 million jobs. It is a number large enough to be meaningless to the imagination unless you hold it against the specific weight of individual human days. The morning alarm, the commute, the particular rhythm of work that gives structure to a life. 400,000 Americans lost their homes to foreclosure in 2008 alone, millions more in the years surrounding it. Communities in California, in Nevada, in Florida, in Ohio, in places the financial press barely mentioned, were transformed in the specific way that foreclosures transform places. Not dramatically, not with fire, but with gradual dimming. Grass uncut, windows dark, the ambient evidence of lives interrupted. And above this, in the stratosphere of the economy, governments were spending trillions to stabilize the institutions that had created the conditions for this devastation. The banks were saved. The system was stabilized. The model was patched. The man's house was sold at auction for $67,000 less than his outstanding mortgage. His credit score would take 7 years to recover. Psychological reveal 6. The sixth truth. The final one I have to offer. I was not the cause. I need to say this carefully because it matters. I was the medium. I was the channel through which the cause expressed itself. The cause was something older and less locatable than a financial instrument. It was the human capacity, perennial, cross-cultural, unkillable, to subordinate long-term consequence to short-term desire, to build systems that allow us to not see what we are doing to one another, to create enough distance between action and consequence that the action feels not just permissible but rational. The loan officer was following the incentive structure. The banker was following the model. The regulator was following the political philosophy of his era. The rating agency was following the revenue. The borrower was following the dream. Each link in the chain was, from the inside, reasonable. That is the thing that should keep you up at night. Not that the system was run by villains. It wasn't. But that the system was run by reasonable people following reasonable logics that, when aggregated and extended over time, produced an outcome that no reasonable person would have endorsed, had they been able to see it whole. We design systems that prevent us from seeing what our systems are doing, and then we are surprised by what our systems do. I want to end somewhere unexpected. I want to end with the tomatoes, he told his daughter. In that summer before the autumn that changed everything, that growing things is never really about the outcome. You plant, you tend, you're present to the process. Sometimes the tomatoes come in small. Sometimes the season is wrong. But the garden was never really about the tomatoes. I am a document. I am ink on paper. I am the legal encoding of a promise that was made with more optimism than foundation. But I was also, in the years before the reckoning, the instrument that put that family in proximity to a garden. That gave a man a morning outside with his daughter and his hands in the dirt and the particular, temporary, unkillable human joy of making something. I burned the economy. This is not metaphor. It is in the dry language of consequence. What happened? The system that replicated me millions of times and abstracted me into derivatives and embedded me in the global financial architecture and refused to listen to the memos. That system burned. And the burning cost more than the mathematics of 8 million jobs and trillions in lost wealth can fully account for, because the mathematics cannot count the garden beds, the evenings, the years of credit rebuilding, the specific grief of a child who doesn't fully understand why her bicycle had to be sold. But I was also, and this is the thing that keeps me from being only a villain in this story, the proof that desire cannot be fully legislated out of the human animal. That the man at the kitchen table was not naive. He was human. He wanted what humans want, a place, a belonging, a morning in a garden with his daughter. The crime was not the wanting, The crime was the system that said yes when it should have said not yet. The system that fed on the wanting and made the wanting. Into mathematics and forgot, in the process of the mathematics, that the wanting had a face. I am paper. I am ink. I am the record of a civilization's conversation with its own desire. I am the first subprime mortgage. And I am still here, in some filing cabinet somewhere, in some legal archive on some digitized record, waiting to see if anything was learned.